Hello everyone, welcome to Atomic ACCA's exam solving series, and in this video we are going to look at the question number 2 of section C financial reporting paper pre-mock exam for June 2025 session. Now we have done with the consolidated SOPL preparation. Now we are going to look at an interpretation question. Let's see what we have here. So the requirement one is calculate the gain on disposal of Pearl company that would be included in SOPL for the group for year ended 31st December X7. Okay, that's a 2 mark question, so we don't have to expect any complications there. Mm, Okay, okay. So one is for calculating disposal. Explain whether the disposal of Pearl company is likely to constitute a discontinued operation and detail the correct accounting treatment. So explain whether it's a discontinued operation and tell the correct accounting treatment. So that's 3 marks. You have to split it across it. Again, a small question. Calculate the following ratios and show the workings. Calculate the ratios and show the workings for Magnolia Group for 20x7 and 20x6. So multiple ands are there. You have to be careful with this. We have four margins to calculate. I mean four ratios to calculate. And what we have after that? Analyze the performance and position of Magnolia Group for year ended 31st December X7 compared to the prior year ended 31st December X6. That is 11 marks. Okay, so we have four requirements in this question. Let's start one by one. Let's go to the previous one, and option number A. Okay, so let's start with this. This is about disposal calculation. We'll just write the format and keep over here. Since we have an Excel sheet, it's really good. We can just make our way through this quick. We don't have to, struggle with the Word document. So the format for this is question number 1: gain or loss on disposal. Now what is the format we follow for this? We take the sale proceeds, then we add with this the fair value of NCI, then we minus out net assets at date of disposal, then we minus out goodwill at date of disposal, and finally we will get what is the uh, you know gain or loss on disposal. All right, so let's just read through this. Magnolia Group operates in the fashion and accessories industry. On 1st Jan X7, Magnolia Company disposed one of its subsidiaries, Pearl Company, on 1st Jan X7. So we are comparing what was that previous question, X6 and X7. So in X6, Pearl Company is there. On 1st Jan X7, so on day 1 itself, it got sold out. So basically in 20X7, that subsidiary company is not there. And you sold it for cash 52 million. So sale proceeds 52 million. Then Pearl Company manufactures home decor items. So what was this? Magnolia Group is in fashion and accessory industry. Pearl Company is in home decor item and was sold because the Magnolia Group decided to focus on fashion and accessory sector internationally. Okay. Extract from consolidated financial statement of Magnolia Group for year ended 31st December X6 and X7 is given. So we have the SOPL over here and we have the SOFP over here. Keep in mind X6 is Pearl Company plus the Magnolia Group together. X7 is only Magnolia Group. So just have an understanding of that. Then we have a small SOFP over here with inventory, cash, and NCL. Okay. Following is the relevant information in this regard. The accounting manager didn't account for Pearl Company as a discontinued operation because the disposal occurred on 1st of Jan X7. Okay. As the division was sold, no information from Pearl Company have been included in X7 financial statement extracts above. Okay. Proceeds from the disposal have been recorded in cash, while all net assets and goodwill have been derecognized. Net assets and goodwill derecognized. Okay, that is correct because you're selling off the subsidiary company. That means you don't have to consolidate anymore. Sale proceeds are going into cash. That is okay. The accounting team is confused about the accounting treatment of the balancing figure. Basically, about the disposal. That is the next question they asked for 3 marks. How to account for it. Now, don't get into too much of lengthy calculations. We saw it was only for 3 marks, and there was some and in between that. So you have to address the different parts. So probably a marking split won't be too difficult over there. Magnolia Company acquired 100% of Pearl Company. Okay, so fair value of NCI is going to be zero. Why? Because 100% of Pearl Company means there is no NCI in that company. You're owning it 100%. So when you're selling it, there is no NCI value over there. On 1st Jan X1, so that is many years ago, it was purchased, which resulted in a goodwill of 8 million. Now, this is goodwill on date of acquisition, 8 million. The goodwill had been impaired by 30% in 20x5, and the net assets at 1st Jan X7 were 40 million. What is 1st Jan X7? Date of disposal. So net asset is equal to 40 million. They're telling goodwill got impaired by 30%. Let's see if any other information is there about goodwill that got impaired further than that. But for the timing, this is the only information given. Initially, it was 8 million, and after that, it got impaired by 30%. So, what is remaining? 70%. So, 8 into 70 percentage. So, the sum of all of this equals to 6.4 million, and that is the goodwill on date of disposal. We'll just see if in case, the gain or loss on disposal. We'll see if any goodwill other figures are coming up or not. But if nothing is there, that is our 2 marks. Then what else is given? Results obtained from Pearl Company's individual statement is over here. So revenue for Pearl Company for both years are given. Gross profit is given. Then profit from operations are also given. So we can make some good analysis about the SOPL part from these items over here, like revenue, then gross profit, profit from operations. So we can get an idea about the operating expenses as well, how much it is going down over here. Then Magnolia Group has moved its accessories division to a building owned by the group, but before disposal, this building was in use of Pearl Company. Previously, accessory division used external facilities on lease for 3 million per year. So you were previously having some lease facility. Now because Pearl Company is gone, that building which was used by Pearl Company, now you moved every accessories and divisions to this. So what possibly could happen? Last year you were paying that lease rental. Now because you moved into your facility, your own building, maybe that lease is not there anymore. So you will have some lease savings as well. At 1st January 2007, that is the date of disposal, Magnolia Group terminated the lease. So that lease is over with a one-off payment of 4 million to lessor. So this one-off payment could be there as an expense within SOPL, but since it is one-off item, you can just point out that item when you're talking in your performance analysis. Then, and this payment was recorded in operating expense. So that could be recorded within this expenses over here, operating expense. So you can mention that over here. Then on 1st Jan X7, the lease still has 8 years remaining. Okay, so when 8 years were remaining, where annual lease rental is 3 million, so you possibly would have to pay 3 into 8, 24 million if you are continuing with the lease, but you decided to pay a 4 million immediately and exit from the lease. So collectively, if you look on a long term basis, the company made a good economic decision. You saved a lot of money. They saved a lot of money. Then Magnolia Group imports raw material from overseas. Foreign exchange gains of 3.5 million were recorded in 20x6, while foreign exchange loss of 2 million was made in X7. So significant foreign exchange fluctuations are happening. You can just give some suggestions like company could get into derivatives, or company could try taking some hedging techniques in order to protect themselves against fluctuation in movement. This word of derivative and hedging, don't get scared by hearing it. It's not something part of FR. If in case you've done your FM paper and you're doing FR, you must be familiar with this. If in case you're not familiar with these things, just a small heads up. Derivatives or hedging techniques simply means that you're getting into certain contract which will help you protect against foreign exchange movements or interest rate movements. Just know only this much as of now. If you have not done FM, when you're doing it later on, you'll study all this. Then these were recognized within operating expenses. So you can, okay, that is also. All right. So now this question is done anyway. So we have to move to next one. About this discontinued operation was the next one, and we had only a discussion over here about discontinued operation. What were the two things we have to address over here? First thing, whether this is a discontinued operation or not. Second thing, what is the accounting treatment? So we can say over here, as per IFRS 5, if a business um, operation is discontinued in the year, and it it is part of one, and it represents a major business line or geography, then it is said to be a discontinued operation. Now, what is the situation over here? Um, what is the company they disposed of? Pearl Company. Pearl Company operates in, what is it? What do they operate in? Home decor, manufacturing home decor item. Operates in manufacturing home decor items, which is different from the rest of Magnolia Group. Hence, discontinuing discontinuing this business line, um, business line. What was the question? Explain whether constitutes discontinued operation. So hence, discontinuing this business line constitutes discontinued operation as per IFRS 5. So first part we addressed. Second thing they asked is, what is the correct accounting treatment when a discontinued operation is there? This needs to be shown on the face of SOPL as a one line item after profit from continuing profit or loss from continuing operation with the title profit or loss from discontinued operation. This figure should also include the gain or loss made on disposal. Explained details of discontinued operations performance can be disclosed can be mentioned in disclosure notes. So we told what is the accounting treatment, and with that our 3 marks is done. So 2 plus 3, we are at 5 marks. Let's keep going. Now we have to calculate the ratios. Again, we are given with the Excel sheet. Maybe in your actual exam you're not going to get the Excel sheet. You might have to make the tables and all for your calculation, so that might take up some time. But since we have some Excel sheet over here, and let's hope that in the actual exam also you get that, then your process would be a little more faster. So what we have to do now, we have to, now what were the and over here, we have to calculate the ratio, but we have to show the workings also. For what time periods? For 20x7 and x6. So we can just write like this. We need to calculate 1 2 3 4, and we need to calculate, let's say this is the name of the ratio we're calculating, and this is the working, and this is the answer for 20x6, and this is the working, this is the answer for 20x7. Just keep in mind, okay, well, this side is 20x6 and this side is 20x7, so don't flip the columns and write it very carefully. Okay, so let's begin. Okay, so first one is gross profit margin, next one is operating profit margin, next we have interest cover, and we have inventory days. Now when we say working, it's not the exact theoretical formula they need. You have to show the numbers that you use. So gross profit margin for 20x6, that is over here. will be equal to 60,200 divided by 145,900. So write very carefully. 60,200 divided by 145,900 into 100. How about over here? That will be 52,400 gross profit divided by 114,800 revenue into 100. Okay. Operating margin would be, operating profit is here, 14,600 divided by revenue is here, 145,900 into 100. And over here it would be for 20x7 we have 16,900 divided by 114,800. It's not coming up. 16,900 divided by 114,800 into 100. Interest covers PBIT by finance cost. So for 20x6, that is over here, it will be 14,600 divided by 7,500, and on the other hand here it would be 16,900 divided by 4,300. Inventory days is inventory by cost of sale into 365. So for 20x6, inventory is over here 26,800 divided by cost of sale is over here 85,700 into 365. And over here it will be inventory is 15,400 divided by 15,400 is inventory divided by cost of sale is 62,400 and into 365. So we got our workings correct. Why this working is very important? Because if in case I wrote the workings over here and I end up writing the wrong final answer over here, I'll still get marks, because examiner can check what numbers I've used and maybe I've just copied it wrongly or so. So I might lose marks like that. I mean, sorry, may not lose marks over there because I have the workings written. But if no workings are available, then it becomes a problem. Now what we can do over here is we can just copy paste it, double click, equal to. We'll just go equal to, take this, equal to, and we'll take this, equal to. Let's just round this down. Okay. Similarly, we'll do over here also. We'll just copy paste it. We'll take the first one, equal to, we'll take the second one, equal to, take the third one, equal to, and we'll take the fourth one, equal to. And we'll just round this down, type the double zeros, take two zeros, and we have our answers over here. Let's just mark this, and we have our answer over here. So these are the 2 years that we have. Next thing, this was for how many marks? This was for 4 marks. So we are done with the margins part. Now we have to start doing the analysis. Next question is analysis. That's performance and position. How many marks were there? We have 11 marks for analysis. We need performance and position. That means performance, let's give 5 marks, position, let's give 5 marks, and 1 mark for conclusion. Let's just roughly split it as such. So we're going to analyze the performance and position. Now they want the analysis of the group. Now what's majorly different in this group analysis? Last year the group was 2 companies basically, the Magnolia Group with Pearl Company, and currently it is Magnolia Group without Pearl Company. So what we can do is we can try getting an analysis from these numbers over here. We have 20x6 over here with 2 companies, 20x7 without Pearl Company. So either we can see like this, what would this year be without Pearl Company? How we can do that? Not all information is available, but some information is available over here. We have the Pearl Company's figures from 40 to 200, 14,800 and 7,000. We can simply look at what would this comparison be and how much would the figures be. Now what we can do, rather than making a table over here, it will take a lot of time. So for comparison purpose, we'll just use that Excel sheet to speed up our process over here, and we'll just make the table. Let's just make this small. Okay, now we have 20x6 over here, and we'll just write revenue cost of sales, gross profit. Then we have operating expense. Then we have PBIT. So this much information is meaning we have revenue, gross profit, and PBIT. Only this information about Pearl company is given. So what we can do is we can find, I mean not find, 20x is already given. 20x6. Take like this. We have 20x6 with Pearl company, and can take 20x7 is over here, right? So we'll just take 20x7 without Pearl company. So I need just one more line over here. Let's just make it 20x6 without Pearl company. Okay. So this is 20x6 without Pearl company, 20x7 without Pearl company. So we can have a like for like analysis. How we'll do that? Revenue over here is for 20x6 is 145,900, 85,700, 16,200. Operating expenses given 45,600, and finally we have 14,600 over here. What is without Pearl company figures? 11,14,800, 62,400, 52,400, 35,500, 16,900. Now what I can do is we have the SOPL for Pearl company alone in 20x6. I can minus this information out and see what is the situation. So if I minus out revenue, that is from this one, if I minus out 42,200, this is the Magnolia Group's revenue from last year to this year. So Magnolia Group is performing better. But if you look at the figures in the normal situation that's given over here, 145 to 114, it seems that revenue is dipping down. But if you look at without Pearl company, you can see that revenue is going up. So that will be one analysis we can do. Gross profit is 14,800. So gross profit is over here. If I minus out 14,200 from this, again you can see from here to here gross profit is going down. But when you remove that and looked at the Magnolia Group alone, you can see that the gross profit is increasing. So that is another indication or another analysis you can do. Last one, profit from operation is 7,000. So profit from operations is this one minus 7,000. So here what is the analysis? Okay, you can see that PBIT with the company, with Pearl company to without Pearl company, like the given information is 14,600 to 16,900. So it's like a very small growth. But when you removed Pearl company, you can understand that there's a massive growth that is happening. So probably the operating expenses are under control for Magnolia company, but for Pearl company, it's not under control. Maybe there is a lot of operating expenses in that. So three analysis we got from here, small analysis we got from here. Plus we can use these margins and figures to do further analysis because these are all performance related analysis. So you can talk from this point of view. So we have information here itself without assessing a lot about other things. From here itself, we can get enough marks for the performance analysis. Now, do we have a way to copy this to the other sheet? Let's just try this. Control C. And if I go to the other question and if I control V, no, it doesn't work. Let's try copy it to the scratch pad. Is there any option to do that? That also doesn't work. So we have no option. So what we have to do, we'll have to, flip the questions one by, flip the screen every time we are doing this in order to make some, answers over here. That's going to be a little hectic, but yeah, anyways, let's try. So first we can start with the gross profit margin. It's going from 41.26 to 45.64. We'll just stick to 41 to 45 percentage. Okay, 41 to 45 percentage. Performance analysis. the gross profit margin for Magnolia Group increases from 41 percentage 41 percentage in 20x6 with Pearl Company to 46 no 45 percentage in 20x7 without Pearl Company. On further analysis, if Pearl Company information is removed from 20x6 group details, the gross profit margin would be how much it would be how much it would be 20x6 without Pearl Company is this much. So gross profit is here, revenue is here, so we'll just take gross margin is equal to gross profit divided by this one into 100. How much it will be? 44 percentage. So last year it was 41 percentage because Pearl Company was there. When you removed Pearl Company, it became 44 percentage over here. So in that case, if I 44 percentage, right, would be 44 percentage without Pearl Company. Hence, when making it a like for like comparison, it can be understood that Pearl Company was not significantly earning high margins on its sale while uh, Magnolia Group was doing so. What could be a reason for this? They are manufacturing home decor item. So manufacturing home decor item means probably they could be selling on, on a wholesale kind of thing because they are manufacturing it. So probably the sales could be a little down. Down in the sense, the margins you can charge would be less on a wholesale business. Comparatively, fashion and accessories industry is something that is where trend keeps on changing, which means even if at a high price you're selling it, there are high chances people will still come and buy. That could be a reason why there is a high margin over there. So give your analysis over there. Okay. The reason could be that Pearl Company manufactures products, which means sale could be on majority wholesale at low margins, while Magnolia Group, being in fashion industry, can charge high prices with changing trends, which still can be sold for high margins. So we gave a good analysis about the margin and the revenue side of what's happening with the company. Now you can give a further oh, we didn't talk anything about the revenue, but you can, that's already understood from here. uh, One more point you can see over here is specific to revenue figures. You can see from the group's point of view, revenue figure seems to be going down, but when removing Pearl Company, you can see that the revenue is increasing. What was the reason for them to dispose of Pearl Company? Because they wanted to focus more on international sales, so they could be achieving that thing. So you can mention it over here. um 103,700. Will it, can I paste it over here? The revenue figures from group to group in 20x6 to x7 seems to be decreasing on its first look. But when removed, but when Pearl company information is removed, this shows that revenue for the group is increasing. This shows that increasing from how much was it? 103.7 to 114.8. 103.7 to 114.8 k. Okay, this shows that their strategic their strategy behind focusing on international sales is being achieved by disposal of Pearl company. So that should be enough. What else we have in this side? We have some discussion about operating margin. What is operating margin movement from 20x6 to x7? Operating margin went from 10 percentage to 14 percentage, so it's going better from x6 to x7. Now if you look at the figures over here, what is the operating margin in this side? Operating margin over here is 7600 divided by 113.700 into 100, so that is 7 percentage. So here it shows that it's going from 10% to 14%, but in reality that group alone without Pearl company is going from 7% to 14%, so that's like 100% growth. That means there is some significant operating expense issues with Pearl company. We can mention that over here. So 10 to 14 and 7 to 14. Okay, the operating profit margin increased from 10% to 14 percentage from the given information, but on removing Pearl company, this shows a massive growth from 7 percentage to 14 percentage. This gives an indication that operating expenses for Pearl company could be significantly higher than rest of Magnolia group. What else can we say? Some one-off expenses were here. Where was it? About lease payments and all these things you can say. Within operating expenses, there are some one-off expenses included. One-off expenses included in current year, like the how much was it? 4 million. Like the 4 million fine paid for early lease termination. But this cost is underweight. Why underweight? Because the benefit is very great up on that. But this cost is underweight by the long term benefit of saving lease rentals. But this cost is underweight by the long term benefit of saving lease rentals of 3 million for the next 8 years, total of 24 million. What else can we say? What else is there? Something about foreign exchange loss is also there mentioned, so you can talk that point over here. Moreover, there is also a significant uh, change in forex figures from a gain of 2 million. No. Foreign exchange gain of 3.5 to 2 million. Okay, foreign exchange gain of 3.5 million to loss of 2 million. This shows that focusing on international markets and purchase of raw materials from abroad has invited some significant exchange rate adverse movements. Magnolia Group must consider taking up hedging products or derivatives in order to ease this out. Okay, so we have around 1, 2, 3, 4, 5. So we have 5 paragraphs about performance analysis, and we have some good amount of information over here. So we can either wind up the performance analysis over here. One extra point, if you want, you can write over here, which we didn't mention yet, is about the interest cover, because that is also part of SOPL. Interest cover, how is the movement going? It's going from 1.95 to 3.93. So interest cover is getting really better, but interest information about Pearl company, nothing is given to us, so we don't know exactly what could be the situation. But you can assume that maybe it is increasing significantly when Pearl company is removed, so probably Pearl company should be having a lot of liabilities with them. You can see over here there's a liability section given to us. That means for SOFP in the whole group, from last year to this year, there's a significant fall in NCL. But again, we don't know exactly what could be the reason for this. One reason could be that long term lease is going away, because 8-year lease means there should be a ROU, there should be a lease liability. When you're getting rid of that, that lease liability goes away. That could be one reason for this. But another reason could be that maybe Pearl company was having significant amount of loans with them, and that is now gone away when they're disposing it off. So you can mention that point. For interest cover, that's going from 1.95 to 3.93. Okay, the interest cover is increasing from 1.95 to 3.93 times over the year for the group, though individual information about Pearl company is not given. It can be assumed that a portion of this increase in interest cover is due to the removal of lease liability as the long term lease is removed from the books. Moreover, this could also be due to the this could be also due to Pearl company having some loans of their own. Right. So that is enough. Now we have done some performance analysis. Let's do some position analysis. Since we don't have a lot of information over here, we may not have to write too much, but let's see. What is majorly changing from SOFP over here? 26,800 to 15,400. Okay, about inventory, we had some information there. Inventory turnover was it? Where is it? Where is it? Okay, inventory days is going from 114 days to 90 days. So inventory days is getting better. 114 to 90 days. and nothing about Pearl company is given over here. So maybe you can assess over here the fact that Pearl company was not being able to sell their items properly, or maybe they were not being able to sell it, fast enough. Comparatively, when that was gone away, the Magnolia Group remaining, they're able to sell it really fast. But either ways, 114 days or 90 days is not big of a concern, because they're in fashion and accessory industry, and the other one is manufacturing home decor item. So anyways, this is not something having a small expiry life or anything. So even if the days are quite large or things, it's not going to matter much for the company, because that's not much of their concern at all, because there's no expiry things or no shelf life or anything. So you can mention that it's going from 114 to 90 days. It's the figure is going well, but from the company's point of view, it's not big of a concern. The inventory days are decreasing from 114 days to 90 days. This is an indicator that Magnolia Group is better able to sell their products in a shorter time span than a Pearl company. But nonetheless, the products, both of these both of these cells are those with length those with lengthy shelf life. Hence, this inventory days is not a major concern for a company within this fashion or home decor industry. Okay, so we mentioned that. What else we have? Cash. Last year cash balance means this is Magnolia Company plus Pearl Company, and this is only Pearl Company. I'm sorry, only Magnolia Company. Now they sold it for how much? 52 million. But what is the difference over here? 39,700 and 18,900. How much is it? 39,700 minus 18,900. So there seems to be only a 2,800 increase in cash balance. But again, we don't know out of this 8,900 how much was Pearl Company. But now it is only going up by anyways 2,800. And if you look at maybe Pearl, the Magnolia Group alone, still it's not a massive difference. Okay, that means out of this, like let's say for example, this if 8,900 was completely Pearl Company, still it is going. The remaining group is going from 0 to 39.7 million. That means out of 52 million, there is a significant portion of money that was used for some purpose. But it's not mentioned over here for what purpose. They did not mention anything about the non current assets, whether they are purchasing some assets or something. They didn't mention anything about inventory, whether they're stocking up a lot of goods. That is also not there, because inventory you can see that it's going down. So that is also not possible. Non-current liability is decreasing. We don't know exactly what's included within this, but we can partially assume that it could be out of this amount of money, some figures could be used to clear off some liability. That could be a reason. But apart from that, maybe you can say that they're trying, the revenues are increasing. So maybe they have invested into some capital investments to, facilitate their international sales. Maybe that could be the reason why revenue is increasing. But we don't know exactly what could be the reason for this. So we can assume it in this way. So we can just take these information from here. The cash balance over the years have increased only by 20.8 million. This means that though it is not clear of how much though it is not clear how much out of 18.9 million is of Pearl Company's cash balance, it can be assumed that A significant portion of the cash proceeds from sale of Pearl Company have been utilized for settling some non-current liabilities, as the non-current liability has fallen from 75.5 million to 53.2 million. Additionally, it can also be assumed that portion of this sale proceeds is used proceeds used for capital expenditures to facilitate the international sales, as this can be figured out from the increase in revenue. What else can we say? 1, 2, 3. About inventory we told, about cash we told, about non-current liability we told. We can say that the fall in non-current liability, that we can say over here, because we told about the fall in NCL in previous point. So you can tell here the fall in non-current liability, if not related to loans of Pearl Company, then it could be due to the removal of lease liability as long-term lease facility is terminated. What else can we say? Inventory we told, cash we told, non-current liabilities we told. Out of nowhere we told something about non-current assets also, but that was too out of the box. We had no much information given. I think that's enough because no more information is available, or my brain is not braining anymore. So yeah, maybe that should be enough. So now let's wind up. So we have 1, 2, 3, 4 points over here, and we had 1, 2, 3, 4, 5, 6. So we have sufficient 10 plus marks within these paragraph. So let's just conclude this. What can we conclude? We can conclude with many things were assumptions over here. So first thing we can say that maybe if we get more Pearl Company information, better analysis could be made. That could be one point we can say. We can also say that on a positive note, they wanted to focus more on the international sales, and based on the performance, things seems to be going really well. So their strategic decision is working out well. Then you can say about the previous question about discontinued operation, that considering this is a discontinued operation in 20x6 comparative information, this needs to be shown on the face of SOPL so that investors can understand this better. Okay, I think around 3 4 points I told, I forgot it. Before I forget further, let's quickly write it. What was the first thing I told? Performance getting better in international sales. Okay. Based on the performance analysis, Magnolia Group seems to be improving in its overall performance. Hence their uh, aim, hence their strategic aim of achieving, or a strategic aim of improving in international sale through disposal of Pearl Company seems to be a success. Next thing I told about was discontinued operation. As currently Pearl Company is not shown as discontinued operation within the comparative information of 20x6. This needs to be considered by the accountants so that users of financial statement can better understand the company. Finally, we told about Pearl company information missing, meaning many things were assumed. As many information regarding Pearl company's individual data, no, as many information regarding individual Pearl company, and also as many information regarding individual Pearl company, and also about the statement of financial position is missing. Analysis were made on assumptions with limited information. Availability of more information regarding the group and individual company could help in improving the analysis. Jai Hind. Okay. So we have done for performance, we have done for position, we have done for some conclusion points. You don't have to write this much big of a conclusion, you can just wind it up in this first paragraph itself. But since that point came up in my mind, I just wrote it over here, that's it. But even if you write or cut down certain points from here, if you write it in a little more smaller sentences, that is totally fine. But watching my previous mock exam solutions or things, you pretty well know that as a ratio analysis is like a favorite area for me. So I'm a story writing person. I write big paragraphs generally for these, the ratios part. So don't mind that. You can actually make these sentences a little smaller. But I like explaining it in a very neat manner. I just compensate with the speed and the size of the answer. If you think that, I always say this thing, if in case you think you're fast enough, then you can write little big answers. But if you think you're slow, then try cutting down the sentences and make it into simple short sentences so that you convey the meaning. Don't cut down sentences in a way where you don't convey the meaning and you write halfway sentences. That will not give you any marks. So I'm always scared about that. What if I write small and the meaning doesn't get conveyed properly? So that's why I write big paragraph, but I don't tell always to follow this or anything. But yeah, this is also doable thing, and you can still stick on to time frame. Don't look at the length of the video because I'm explaining and doing it. That's why it takes a little bit time. But if you're writing it like a student in the exam sitting where the pressure will be on and you'll be continuously writing it, then you'll definitely make it within the time frame. But hope you have understood how we broke down the question, how we understood, how we utilized some extra information from the previous things. Like they asked us only to do these, but we took up some extra information to boost our analysis. We can write over here as well, like a first liner. You can just say maybe all figures used for analysis is mentioned in the spreadsheet in question C. So examiner knows that I'm not bluffing the numbers. They can also just cross refer it from there. So hope this was helpful in the analysis part of how do we do it with a consolidated um, statement as well. And if in case you want more tips on how to do the analysis, you can watch the other mock exam video that is there already on YouTube, and you can see how we have solved that question. It could be a little different from this, but you can get some insights from that as well. So hope everything was clear from here. Now we are done with our predictable area, our favorite area. We've scored some amount of marks. Now we have gained some confidence. Now what we have to do, we have to go put our head into the unpredictable area, because anything from the syllabus could come up there. could be easy, sometimes it could be easy mark, sometimes it could be complicated, sometimes it could be an accounting standard that I have no clue about, or I thought that didn't have high weightage in the exam and I could have skipped it in the exam. So anything could come up. Let's see how to solve section A and B for this particular exam. So hope this was helpful, and if anything particular that helped you out in this particular video or anything else from our videos, make sure to comment it down and let us know how these videos are helping you out in your preparation. So that's it. See you in the next video, and share this to any other friends that are preparing for their FR exams as well. See you in the next question. Bye bye.